Here's something that surprises almost everyone who buys a home. If you take out a 30-year mortgage today, for the first several years, the vast majority of every single payment you make doesn't go toward your home at all. It goes to interest. Not principal, not equity, interest. By the time you've made your very first payment, less than 15% of it actually reduced what you owe. Today, we're opening up the math behind a mortgage, exactly where your money goes, month by month, and why understanding this changes how you think about paying one off. Most people think of a mortgage payment as one single number. You pay it, the balance goes down. Eventually, you own the house. In reality, every single mortgage payment is split into two very different pieces, principal and interest. Principal is the portion that reduces your actual loan balance. Interest is the cost of borrowing the money. Here's the part that surprises people. Those two pieces don't stay in a fixed ratio. At the start of your loan, a bigger share of each payment goes toward interest. As your balance decreases, that shifts, and more of each payment goes toward principal. By the final payment, you're paying almost entirely principal. This process has a name, amortization, and once you understand how it works, a few things about mortgages that seem confusing suddenly make complete sense. Why your balance barely moves in the early years, why refinancing later can sometimes reset the clock in a costly way, and why even a small extra payment early on can save you tens of thousands of dollars. Part 1. How the monthly payment is actually calculated. Your fixed monthly principal and interest payment comes from a specific formula that takes three things into account: how much you borrowed, your interest rate, and your loan term. Let's use a realistic example. Say you're buying a $400,000 home with a 20% down payment. That's $80,000 down, leaving you with a $320,000 loan. As of the week ending July 23, 2026, the average 30-year fixed mortgage rate was 6.58%, according to Freddie Mac's primary mortgage market survey. Run those numbers: $320,000 borrowed, 6.58% annual interest, 30 years, and your fixed monthly principal and interest payment comes to $2,039.48. That number will not change for the entire 30 years, as long as you have a fixed-rate mortgage. What changes is how that $2,039.48 gets split each month. Part 2. Why the split shifts so dramatically over time. Here's the mechanic that explains everything. Lenders calculate interest based on your remaining balance. The higher the balance, the more interest you pay. Since your balance starts at its highest point on day one, your very first payment carries the heaviest interest load of the entire loan. In our example, here's exactly what happens to that first $2,039.48 payment. $1,754.67 goes to interest. Only $284.82 actually reduces your loan balance. That's 86% of your payment going to interest and just 14% building equity. Now fast forward. By year 5, payment 60, the split has shifted, but only modestly. $1,646.22 to interest, $393.26 to principal. You've only paid off about 6.3% of your original loan balance after 5 full years of payments. By year 10, it's $1,493.51 to interest versus $545.98 to principal. By year 15, you're at $1,281.49 interest versus $758 principal. Getting closer, but interest still wins. Here's the number that surprises most people. The crossover point, the exact month where your principal payment finally becomes larger than your interest payment, doesn't happen until month 235. That's 19.6 years into a 30-year loan. For nearly 2/3 of your mortgage, you are paying more in interest than you are in actual equity. By year 25, the picture has flipped hard. $578.47 interest, $1,461.01 principal. And by the very last payment, month 360, it's almost entirely principal. $2,028.36 principal against just $11.12 in interest. Part 3, the total cost of borrowing and what most people don't expect. Add up every single payment over all 30 years, and here's the total: $734,213.81. You borrowed $320,000. you'll pay back $414,213.81 in interest alone, more than the original loan amount itself. That's not a hidden fee or a bank trick. That's the mathematical cost of borrowing money over 3 decades. Part 4, your mortgage payment isn't just principal and interest. Here's something many first-time buyers miss. What you actually pay your lender each month is usually more than just that. $2,039.48 principal and interest figure. Lenders bundle in property taxes and homeowners insurance, sometimes private mortgage insurance too, into one combined monthly payment, commonly called PITI principal, interest, taxes, and insurance. On our $400,000 home, if the local property tax rate is around 1.1% annually, that adds roughly $366.67 a month. A typical homeowner's insurance policy might run $150 a month. Since we used a 20% down payment in this example, private mortgage insurance isn't required. PMI is required when your down payment is less than 20% of the purchase price, protecting the lender if you default. Add it all together, and your real monthly payment is about $2,556.15, over $500 more than the principal and interest number alone. That gap is exactly why so many new homeowners feel like their mortgage payment is higher than they expected. The number a lender first quotes you is often just principal and interest. The full picture requires taxes and insurance too. Part 5, why extra payments matter more early than late. Because interest is calculated on your remaining balance. Paying down that balance faster, even by a small amount, reduces every future interest calculation. This is where extra payments become powerful. Take that same $320,000 loan and add just $200 extra to the principal every single month, starting from payment 1. The loan that was scheduled to take 30 years instead pays off in 280 months, 23.3 years. That's 6.7 years shaved off the loan. And the interest saved over that time? $107,529.96. An extra $200 a month? Roughly $2,400 a year, saved over $107,000 in interest. That's the power of attacking a balance that's front-loaded with interest. Let's bring this to life with 2 homeowners, Amaya and Rob, who each buy an identical $400,000 home with the same $320,000 loan at 6.58% for 30 years. Amaya pays exactly the scheduled $2,039.48 every month, nothing more. After 5 years, she's paid roughly $122,000 total, but her loan balance has only dropped by about $20,000. The rest went to interest. She still owes roughly $300,000 on a home she's been paying into for half a decade. Rob pays the same $2,039.48, but adds an extra $200 every single month from day one, a total of $2,239.48. After 5 years, he's paid about $12,000, more than Amaya in total. But because that extra money attacked the principal directly, during the years when the balance, and therefore the interest, was highest, his loan is now on track to be paid off in 23.3 years instead of 30. Over the life of the loan, he'll pay $107,529.96 less in interest than Amaya, despite living in the exact same house, same home, same rate. Same loan. The only difference is $200 a month applied early, and it changes the entire financial outcome of the mortgage. Here's the short version. Every mortgage payment splits into principal and interest, and that split shifts dramatically over the life of the loan, starting interest heavy, ending principal heavy. On a typical 30-year loan, the crossover point where principal finally overtakes interest doesn't happen until nearly 20 years in. Your actual monthly payment is usually higher than principal, and interest alone, property taxes, homeowners insurance, and sometimes PMI get added on top, forming what's called PITI. And because interest is calculated on your remaining balance, extra payments made early in the loan have an outsized effect, reducing both your payoff time and your total interest paid, far more than the same extra payment would if made later. If you have a mortgage right now, pull up your amortization schedule and see exactly where you are on that interest to principal curve. It might surprise you. Drop a comment with what you find. Next video, we're breaking down how tax brackets actually work, because most people think being pushed into a higher bracket means all their income gets taxed at that rate, and that's not how it works at all. Subscribe so you don't miss it.